I've made the point, not just this time, but before and before and before, and about every before years, that the 9 months that begin October 1st of a midterm election year is the most consistently profitable period in all of stock market history, and I've pounded the table on that for a long time.
Just a while back, I stumbled upon this video featuring Cam Fisher, the founder of Fisher Investments. He's basically trying to predict what the economic future holds, attempting to foresee what's in store for the rest of this and next year. He's using a century's worth of data to see how US elections have historically influenced the markets. Now let's listen to his thought process.
Before this cycle. And the fact is, I coined a phrase for it a long time ago, the midterm miracle. We had a great midterm miracle this time. And the fourth quarter was positive last year, starting the beginning of this bull market. And then the next two quarters were similarly positive, each of them running around 7%, a little over. So we end the first half up more than 15% on the S&P 500. And that's a great first half of the year, and it's a great conclusion to the midterm miracle. So what happens after a midterm miracle? And on that, we got a lot of data because we got history going back with really accurate data going back to 1925. And we can say that the back half of third years of president's terms, the aftermath of the midterm miracle, is not as positive as the first half. First half is positive 92% of all years. But the back half is positive about 80%. And the average return in the back half isn't as good as in the first half, but on average it's about 5.5%. Excuse me, I misspoke myself. It's about 7.5%, about half of what you get in the first half of the half. But the fact is, it's still pretty good. And in fact, going back to 1925, there have only been two periods where the back half was double-digit negative. One, 1931, going into the Great Depression. And then two, in the flash crash of 1987, arguably the fastest bear market in history, which it really isn't because the 2020 COVID bear market was the fastest bear market in history, but it was the fastest bear market in history for a long time. And that time period and the 1931 time period don't look anything like this time period. And other than that, the back half has only ever been off. Of the 6 times ever that the back half was negative, the worst ever was down 3.7%. This is not a very dangerous time.
Midterm miracle essentially means that the first half of 2023 was expected to be the most profitable period for the stock market, and it lived up to that expectation. The S&P 500 index, a key stock market indicator, climbed from 3,800 to 4,600 points, marking an impressive 17% gain in just 6 months. Politics clearly has a significant impact on the stock market. In the first 2 years of a president's term, there's usually a lot of focus on major policy changes, which can create uncertainty. This uncertainty tends to have a negative effect on the markets. However, as we move into the second half of the 4-year presidential term, things tend to stabilize. The current president also starts thinking about their re-election, which often results in an economic upturn, although sometimes it's influenced by policies designed to boost the economy artificially. Historically, the first half of the year before a presidential election year is typically positive for the stock market. But what's behind this upward trend, and what can we expect in the second half of 2023?
The same thing that causes the midterm miracle, which is the shift from high political risk aversion in America, as big legislation is going through boom, boom, boom in the first 2 years of the president's term, like we had in President Biden's presidency, but before that in President Trump's presidency, and before that in President Obama's presidency, and then George W. Bush, and then Bill Clinton, etc. All big, huge, scary, controversial legislation in modern American history. goes through in the first 2 years, and we all get freaked out by that. And then the midterms bring in absolute or relative gridlock, and that stops. And the chatter and the political rhetoric keeps being blah, 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 blah. But the actual legislation just quiets down, which you may have noticed. But it takes us a long time to adjust to the fact that you get stability for a few years, you get relative quiet in your ability to plan, and businesses love that.
If you're an American company, you prefer smooth sailing, right? No one wants to juggle a ton of new laws or get tangled up in global politics, well, unless you make weapons. What you want is a robust economy, low interest rates, and a crystal clear vision of a peaceful future where you can plot your course. But here's the $1,000,000 question. Is this prosperity going to stick around for the coming months? In other words, is it time to roll the dice on investments now, or should we just hold off for a while?
So in that reality, the effect lingers longer. I'm just going to go on a little further. The fourth year of a president's term isn't nearly as good as the third year. The third year has the miracle and the aftermath of the miracle. But the fourth year of president's term has been positive 83% histories in the history of the S&P 500 and has lower average returns than the third year, only a little over 11%, but it's still pretty nice. This is not a bad time. Most of the risk in the stock market in the United States and overseas, because overseas tends to ripple to what the U.S. market does with a reasonably high correlation. But most of the risk is in the first 2 years, where you get a lot of big double-digit positives, but you also get a lot of negative years in both the first and the second year. We're not there now. So my general advice is, yes, can we get downturn from here? Of course we can. Is the odds of that high? No, it's low, and it takes something big, bad, and that we're not all talking about to make that happen, because if it's big and bad and we're all talking about, it's already been priced into the market now. And if we're talking about all kinds of things people are afraid of that are false, fear of a false factor is always bullish when things turn out to be better than people feared because it was a false factor, and that surprise is bullish. So my general view is this is a pretty good time to own stocks. As good as 6 months ago? No, of course not. Is it as good as it was 9 months ago? No, of course not. But the reality is it's still a pretty good time. It's still a bull market, and you should enjoy it.
Alright, so based on historical trends, here's what we're looking at for the next year and a bit. If we start from July 1st, we're likely to see the market grow by 7.5% by the end of this year. And next year, things should stay positive with an expected return of around 11%. That doesn't sound too bad. But don't forget, these are just educated guesses. Even though Ken Fisher is a great investor, anything can happen. With the current economic challenges, you can bet on a surprise or two along the way. So stay alert and ready for whatever the financial roller coaster brings.